It is exactly 2:30, and I think it's 1930 Greenwich Mean Time. So let me officially call this hearing to order. Senator, nice to see you. I'd like to welcome everyone to the Joint Economic Committee's hearing titled Demystifying Crypto, Digital Assets, and the Role of Government. I want to thank all of our truly distinguished witnesses for sharing their expertise today. We'll begin with my opening statement and then hear from Senator Lee. Since the introduction of Bitcoin in 2009, the market for cryptocurrencies and other digital assets has expanded from a niche product to a globally significant asset worth nearly $3 trillion last week. While this rapid rise in value has made some early adopters quite wealthy, it also poses an array of risks both to everyday investors and the broader financial system. The purpose of this hearing is to explore emerging trends in the digital asset market and discuss prudent steps that Congress and the federal government can take to update our regulatory framework and bring much-needed clarity to issuers, ensure transparency for investors, and protect the integrity of our financial system while also leveraging exciting developments in blockchain technology. Congress can promote responsible innovation in this market while also providing basic protections to the investing public. Interest and involvement in the digital asset market has become increasingly mainstream in recent years. The growth of these products has been especially pronounced since the start of the coronavirus pandemic, as the reported total market value of all digital assets soared from $200 billion with a B in January 2020 to nearly $3 trillion with a T just last week. To put that in perspective, recent price volatility in digital assets has erased $400 billion in value just in the last 7 days, an amount roughly equal to the entire size of the market just a year ago. As the market has grown, we've seen digital asset investors broaden from a narrow group of true believers in cryptocurrencies to an expanding community that includes everyday investors. A Pew survey conducted this fall found that 16% of American adults have personally owned or invested in a cryptocurrency at some point, up from just 1% that held any Bitcoin in 2015. While many early Bitcoin transactions occurred on little-known platforms, today investors can buy digital assets through Robinhood or Venmo, or on large exchanges run by publicly traded companies like Coinbase. But this growth in value and interest presents a number of challenges for our economy. The current digital asset market structure and accompanying regulatory framework are ambiguous and risky for both investors and the broader economy. Digital asset holders have been subjected to a market that is, as SEC Chairman Gary Gensler has described, rife with fraud, scams, and abuse. The mainstreaming of digital assets is laying the foundation for a huge swath of the economy to invest in this market. Increased crypto market volatility or digital bank runs could disrupt more mainstream financial institutions like pension funds and mutual funds. And the underlying assets can create significant consumer protection issues given existing patterns of financial fraud, hacks, and market manipulation. Retail investors may be lured in by the hype around a new coin with improbable high rates of return, only to be caught on the wrong end of a speculative bubble and lose their entire investment. A recent example is Squid, a blatant scam token that used the excitement around the popular TV show Squid Game to dupe unwitting investors out of $3.3 million. While all investments involve risk, the lack of disclosure and reporting requirements in many parts of the crypto asset industry tilt the playing field towards the largest investors who can leverage their size to exploit regulatory gaps at the expense of retail investors. It's currently difficult for regulators to prevent market manipulation by large players who can exploit their access to multiple sides of a trade or trade on inside information. Despite these issues, Congress has not yet weighed in on a comprehensive legal framework around these assets. Updating the U.S. regulatory framework for digital assets would be in line with how officials have responded to past financial innovations, although often after the fact, with stronger rules to protect consumers and market integrity. For example, Dodd-Frank created stronger rules on complex swaps and derivatives in the wake of, that is after, the 2008 financial crisis. Updated regulation can also reduce the likelihood that these emerging developments would destabilize financial markets and the broader economy. For example, the largest stablecoin, Tether, was recently found not to hold sufficient reserves of cash and equivalents to fully pay back their $70 billion value. Applying regulatory scrutiny to assets like Tether and platforms on which they're used could ensure that cracks in one asset don't spread to the larger economy. Increasing reporting for decentralized finance platforms will shine a light on a fast-growing but lightly regulated segment of the market. Increased information sharing would also improve tax compliance for capital gains from the sale of crypto assets. The many issues we'll discuss today are why I introduced the Digital Asset Market Structure and Investor Protection Act earlier this year. Just a start. This legislation would establish much-needed guardrails and provide clarity to regulators and investors without stifling innovation. The present moment gives us an opportunity to take action before a potential crisis hits the broader economy. So I really look forward to learning from each one of our witnesses today and from my peers' questions. So Senator Lee, the floor is yours.
Thanks so much, Mr. Chairman. Throughout the history of our great nation, entrepreneurs and creators have served as the heartbeat of the American economy and the engine for America's economic growth. Their advances into unknown frontiers of science and technology have transformed quality of life for millions upon millions of Americans, and also for people around the world. Today, American innovators are advancing into unknown frontiers of cryptocurrencies, using novel technologies to securely create and trade digitally scarce assets. Like the internet of the 1990s, cryptocurrencies are still in their infancy. This evolving technology has vast and still very much untapped potential to revolutionize established industries and to create entirely new ones. Cryptocurrencies are already democratizing finance by lowering costs and expanding access to an industry that has historically been hard to reach for millions of Americans, including hundreds of thousands of Utahns. Beyond the better-known applications to finance, blockchain, which is, of course, the technology behind cryptocurrencies, has even broader potential. Blockchain can securely share health records, efficiently track cross-border transactions in global supply chains, and allow online consumers to verify the authenticity of pictures or videos. I have great optimism that, like the internet before it, the technology behind cryptocurrencies, meaning, again, blockchain, is something that's going to create a wealth of new opportunities, many of which we can't even really imagine yet. As new markets like this one emerge and grow, there's always going to be a temptation here in Washington to expand the federal government's reach, a temptation to centrally control the innovative process and regulate the products of those individuals who are at the forefront of American advancement. But this is a temptation that must be resisted. Rigid one-size-fits-all regulation is something that's kind of scary, especially when it's targeted at the cryptocurrency. It's certainly unnecessary. And it would all but ensure that this next generation of technology companies would end up moving to other countries other than the United States. Americans could lose access to cryptocurrency markets and miss out on the potential economic and social benefits. If we want the center of innovation to remain right here in the United States for the benefit of American workers and American families, Congress should focus on creating clarity around how existing rules apply to these new technologies. In the case that existing law proves outdated or insufficient, then we can assess the need for new rules. However, as it stands today, we just need to appropriately apply the rules that we already have that are already on the books, most of which are applicable here, and most of which are very much sufficient. The proper role of government is to empower innovation through clear rules with a light touch. The best approach is one in which Congress acts in a manner that's tailored to its limited constitutional authority. It's one where the federal government acts with restraint, and in so doing, protects the creation and ingenuity that powers our great country. Because when we restrain government, we unlock unlimited human potential that among the American people is immense. In today's hearing, I hope we can focus on policies that protect a flexible regulatory framework for Americans who are building our future. If we can resist centralizing power in Washington, as has long been the impulse of Democrats and Republicans alike in this town, and instead preserve this space for American innovation to flourish, entrepreneurs across the country stand ready to unleash the tremendous opportunity of new digital economies. Thank you, Mr. Chairman.
Senator Lee, thank you very much. Now I'd like to introduce our four distinguished witnesses. Ms. Alexis Goldstein is the Financial Policy Director at the Open Markets Institute. She previously worked in financial regulatory policy, climate finance, consumer investor protection, and higher education for Americans for Financial Reform. Prior to working in advocacy, she spent 7 years working on Wall Street as a programmer at Morgan Stanley in electronic trading, as a business analyst at Merrill Lynch and Deutsche Bank in equity derivatives. Mr. Timothy Massad is Senior Fellow at the Kennedy School of Government at Harvard University and an Adjunct Professor of Law at Georgetown Law School. From 2014 to 2017, he served as Chairman of the U.S. Commodity Futures Trading Commission. Under his leadership, the agency declared virtual currencies to be commodities, introduced reforms to address automated trading, and strengthened cybersecurity protections. Mr. Massad has a BA from Harvard College and a JD from Harvard Law School. Mr. Kevin Werbach is a professor and department chairperson of legal studies and business ethics and director of the Blockchain and Digital Asset Project at the Wharton School of the University of Pennsylvania. His work focuses on telecommunications and internet policy, as well as applying digital game design techniques to business. Before joining the Wharton faculty, he served as a counsel for the new technology policy at the Federal Communications Commission during the Clinton administration. He's published 4 books, including The Blockchain and The New Architecture of Trust. Mr. Werbach received a BA from the University of California at Berkeley and a JD from Harvard Law School. Finally, we have Mr. Peter van Valkenburgh, who's the Director of Research for Coin Center. Formerly, he was the Google Policy Fellow for Tech Freedom. He's a graduate of NYU School of Law and a self-taught designer and coder. So welcome, all of you. We have 5 minutes for each of your testimony, and we will begin with Ms. Goldstein and then continue in the order of introductions. Ms. Goldstein.
Thank you so much. Chair Beyer, Ranking Member Lee, and distinguished members of the committee, thank you for inviting me to testify today. My name is Alexis Goldstein, and I'm the Director of Financial Policy at the Open Markets Institute, where my work focuses on financial regulation and consumer protection. As the chair mentioned, I previously worked on Wall Street as a programmer at Morgan Stanley and then as a business analyst at Merrill Lynch and Deutsche Bank prior and during the 2008 financial crisis. I am not only a researcher of digital asset markets, I am also a user of them. I have used large exchanges, I have used so-called decentralized finance platforms or DeFi, I have tried out Layer 2 solutions, and I have bridged from one blockchain to another. And my impression as a user and a student of these systems is that while many claim that this is the future of finance, it looks a lot like the history of finance to me. The space is full of intermediaries and rent-seeking. For example, if you wanted to swap one crypto asset for another on Ethereum today, you'd have to pay over $100 to a miner to execute your transaction on the Ethereum blockchain. If you wanted to do it last week, it might have cost you hundreds of dollars to do so. If you are a large entity, you can also front-run transactions by effectively bribing the miners. You can essentially up the transaction fee that you want to pay to the miner, and they will execute your transaction before others. Many of these ostensibly decentralized finance platforms also make use of the very same forced arbitration clauses and class action bans that the biggest banks in the United States do, in order to deny their customers the right to sue over disputes in a court of law. We have also seen the CEO of a major crypto lending and borrowing platform called Compound unilaterally threaten to report their users to the IRS if they had benefited from a software bug that Compound itself created, raising more questions about whether this particular platform is truly decentralized. One of the problems that we see in the existing financial systems is that users with the least amount of money often pay disproportionately high fees. And unfortunately, I have found this problem is largely replicated in digital asset markets. Coinbase, for example, has 2 cryptocurrency exchange platforms, Coinbase and Coinbase Pro. Coinbase is aimed at newer users, but charges astronomically higher fees than its Coinbase Pro offering. There are also large concentration concerns in the digital asset space. Facebook is one example who is moving ahead on its digital asset pilot despite ongoing questions and concerns from lawmakers, concerns that their plans may be incompatible with the current financial regulatory landscape. Venture capitalists also play a significant presence in the cryptocurrency markets and appear to hold considerable market power and power over the governance of many of these platforms, and their investment is growing fast. VC firms invested $17 billion in digital asset firms in the first 6 months of 2021, which is more than 3 times what they invested in all of 2020. Hedge funds, family offices, and large too-big-to-fail banks are also a growing presence in the crypto markets. There are also questions about conflicts of interest among major market players. To take a single example, the CEO of the exchange FTX, Sam Bankman-Fried, reportedly also owns 90% of a proprietary crypto trading firm, Alameda Research. In traditional financial markets, barring a serious liquidity crisis, you will be able to sell back the product that you purchase. But on DeFi, it is very easy for malicious actors to design tokens that can be bought but never sold. Some crypto investors solve for this by reading the code of new coins to look for pitfalls and ensure they don't fall prey to these kinds of scams. But this is a fairly high bar for non-programmers. I worked on Wall Street before and during the 2008 financial crisis before Dodd-Frank. And much what I saw working with the then unregulated over-the-counter derivatives market reminds me of some of the things I see in today's digital asset marketplace. Systemic risk tends to arise when the scope, size, scale, or interconnectedness of certain activities metastasize and spread contagion to the broader financial system. There are several concerning items, including leverage, opacity in market data, and poorly understood interlinkages between market participants that are currently present in digital asset markets and may indicate potential systemic risk. Congress should continue to examine if there are regulatory gaps that require new legislation in order to ensure consumer and investor protections and ensure that regulators have the market data they need to evaluate for systemic risks. For their part, regulators should continue to monitor the space and ensure compliance with existing laws and regulations. Thank you, and I look forward to your questions.
Thank you, Ms. Goldstein, very much. Next, hear from Mr. Massad.
Chair Beyer, Ranking Member Lee, and members of the committee, thank you for inviting me to testify today. I first testified about crypto in 2014, and it is an honor to be here. I would like to make 8 points. First, there is no question that digital asset innovation is incredibly important and beneficial overall. But there should also be no question that the time to strengthen and clarify regulation of digital asset markets is long overdue. If done responsibly, it will support, not suppress, innovation. Second, stablecoins are one of the most urgent challenges. If properly regulated, they might help modernize our payment system. But today they pose significant risks. The recent report of the President's Working Group on Financial Markets describes this very well. It calls on Congress to adopt legislation that limits stablecoin issuers to insured depository institutions. I prefer a slightly different formulation where we have some bank-like specific regulations of the risks, but we limit the issuer's activities so they aren't making loans and they aren't doing all the things that traditional banks do. And in that model, deposit insurance may not be necessary. This is a better way, I believe, to foster competition and innovation and address the risks. Third, I agree with the PWG report on the need to regulate stablecoin arrangements generally, not just the stablecoin issuer. Once issued, stablecoins trade on decentralized blockchains pursuant to smart contracts, as well as on centralized exchanges. This means that no single authority is responsible for the overall operation of the stablecoin. And with regard to decentralization, or what is called DeFi generally, it can be a good thing, but calling something DeFi should not make it a regulatory-free zone, and we should keep in mind that that label can mean lots of different things. We need to apply standards, appropriate standards, to financial market activities, not the technology itself, that occur on such platforms. Fourth, Bitcoin is neither a widely accepted means of payment or a stable store of value today. It is a highly volatile, speculative investment. It might be tempting to just say, let the buyer beware. But the continued growth of a largely unregulated crypto market poses risks to society, including risks of illicit activity, tax evasion, ransomware, investor fraud, and potential harm to broader financial markets. We do not have sufficient information about this market. Neither the SEC nor the CFTC has authority today to regulate the cash or spot market, if you will, for digital assets that are not considered securities. That's a point that's actually not understood by many people, and that is where most trading activity occurs today. So we should expand that authority. At the same time, we should make sure our regulatory policies are adequately informed by technological expertise. This is very, very important. Fifth, in regulating crypto generally, we must balance reasonable expectations of privacy in financial transactions with the government's legitimate interests, such as preventing illicit activity and tax evasion. Sixth, the evolution of digital assets has made it clear that we need to modernize our payment system. It is relatively slow and expensive. A central bank digital currency is one way of doing so. There may be other ways as well. My concern is we're not moving fast enough to either develop a prototype CBDC or to determine what the best strategy is. Seventh, CBDCs, stablecoins, and digital assets generally are often cited as a means to achieve greater financial inclusion, and we should consider their potential for doing so. But we should act now to improve access to financial services through other means as well. The need is too great, and this should not be deferred. Finally, the challenge we face is not unusual because the financial sector constantly innovates, and our regulatory system has to catch up. I helped draft the original agreements for swaps 30 years ago, and swaps created a lot of beneficial hedging. But the industry resisted regulation and eventually generated excessive risks that almost brought down our financial system. It was only then that we created a regulatory framework under which the industry is thriving today. To conclude, we should take some actions now to strengthen the regulatory framework, and some key things that Congress should do are, first, require that stablecoin issuers and related arrangements be supervised by the Fed or the OCC along the lines I've suggested. Two, give the SEC or the CFTC clear authority to regulate the cash market for cryptocurrencies. Three, make sure FinCEN has the tools and resources it needs to implement KYC, AML, and CFT standards thoroughly. And four, urge the Fed and the Biden administration to accelerate work on modernizing our payment system, including by developing a hypothetical CBDC. Thank you, and I look forward to your questions.
Thank you very much, Mr. Massad. Well, next hear from Professor Werbach.
Chairman Beyer, Ranking Member Lee, members of the committee, thank you for the opportunity to speak before you today. Blockchain technology and the digital asset ecosystems it enables could well represent the most important developments in information technology since the internet. The potential exists to not only improve the efficiency of many kinds of transactions, but to make markets more fair, inclusive, open, dynamic, and transparent. At the same time, there's no question these same technologies can be and are used by criminals, fraudsters, and other bad actors. There are major risks involved in digital asset-based markets, and it's important to distinguish potential from reality. These are still, in many ways, immature technologies. There are important questions about energy usage of proof-of-work networks, holdings of most digital assets are highly concentrated, and there are serious concerns about market manipulation. It's essential for both market participants and policymakers to set a course to accentuate the benefits while limiting the harms. Regulation and innovation are not necessarily in conflict. In many cases, regulatory action to address abuses and provide clarity is an important or even necessary condition for long-lasting and transformative innovation. A quarter century ago, I served on the White House working group that drafted the Framework for Global Electronic Commerce, the US government's approach to the internet. The policy adopted then was not that the internet should be a totally unregulated space or that the harms it brought should be ignored in light of its benefits. While the framework opposed, quote, undue restrictions, it also identified the need for a predictable, minimalist, consistent, and simple legal environment. That is what we should be seeking today for cryptocurrencies and digital assets. Take, for example, decentralized finance, or DeFi. DeFi could create a more open, inclusive financial services environment by removing intermediaries and improving access to capital, increasing the velocity of assets, facilitating service composability, unlocking yield opportunities, all have the potential to increase risk-adjusted returns available to market participants. However, DeFi also poses significant dangers, which were detailed in the DeFi Policymaker Toolkit a collaboration of the Wharton Blockchain and Digital Asset Project and the World Economic Forum. The challenge DeFi poses is how to address these challenges and risks through regulation. A centralized cryptocurrency exchange has a corporate parent, offices, management team, custodial assets, and typically licenses or registrations. An automated market maker, AMM, or other on-chain DeFi protocol, though, need only be software, code running on a decentralized global blockchain network. While this may sound like an insoluble problem, it's likely to be manageable in practice. First, DeFi services are heavily dependent on stablecoins as on-ramps and off-ramps. Clarifying the regulatory context around stablecoins and ensuring they're subject to appropriate obligations could help address the DeFi regulatory conundrum. Second, users often access DeFi functionality through websites and services maintained by protocol developers. Some developers have already taken steps, such as blacklisting tokens whose trading would clearly violate securities laws. Finally, DeFi protocol and governance tokens did not appear from nowhere. The moment of token issuance is an important regulatory opportunity. This is, for example, an area of focus of MiCA, the European regime under development now for non-securities digital assets. The history of peer-to-peer or P2P file sharing applications such as Napster 20 years ago also provides a helpful roadmap for how seemingly unregulable services can be addressed. These applications were held liable for copyright infringement when they maintained essential components of central control or when they knowingly induced illegal activity. Going forward, Congress should take a three-pronged approach to the regulatory questions that cryptocurrencies raise. First, where possible, provide breathing space and help policymakers gain greater understanding of market dynamics. Second, quickly address the low-hanging fruit. There are laws and regulations with language that inadvertently fails to accommodate digital assets, and fixes are relatively uncontroversial. There are also too many obvious bad actors who have not faced legal consequences, and large players in the blockchain ecosystem credibly accused of systemic market manipulation. Third, at some point, outdated legal frameworks are no longer technology neutral or effective. Over time, we will need to reconsider the basic foundations of financial regulation put into place nearly 90 years ago after the Great Depression. Such an effort will position the U.S. to maintain its leadership in the global financial system as it moves into its next technological transition and leadership in the emergent sphere of blockchain-based activity. I look forward to your questions.
Thank you, Professor, very much. And last, we'll hear from Mr. Van Valkenburgh.
Chair Beyer, Ranking Member Lee, members of the committee, thank you for this opportunity to speak with you today. On Halloween 13 years ago, an email to a public mailing list shared a link to a PDF. It was the Bitcoin white paper, 3,192 words, a handful of simple illustrations, and some C++ computer code. The following January, a 2-megabyte computer program was made freely available for download to the same public mailing list. Less than 5 years later, the person or persons sending these emails under the pseudonym Satoshi Nakamoto sent their last message and has not been heard from since. Today, a few thousand words, a computer file smaller than a cat video, and a missing author have brought about an economic revolution. Over $3 trillion worth of economic activity recorded and secured on blockchains, shared ledgers that no single person, corporation, or government permissions or controls. Who can we thank for that remarkable, utterly unpredictable outcome? Not just the person or persons who went by Satoshi, they stood on the shoulders of brilliant cryptographers and computer scientists. Perhaps above all, they were inspired by another shared and open computer network that no single person controls, the internet, a place where a good idea shared anonymously and publicly can stand on its merits, spread to a community of like-minded innovators, and flourish. America grew rich because of that openness. The ingenuity of immigrants, entrepreneurs, explorers, and technological pioneers. We don't like permissioned systems in this country because we know that you can't prejudge genius. We want open systems that afford dignity and access even to people we don't yet know or understand. As Steve Jobs would have put it, the crazy ones, the misfits, the rebels. So I'm not going to tell you who is going to show up on the Bitcoin blockchain or the coming decentralized web, or what exactly they're going to build. I couldn't tell you that today any more than I could have told you in 1990 that Satoshi would show up on the internet alongside Sergey and Larry with Google and Jimmy Wales with Wikipedia. All I'm going to tell you is that we've finally built a tool that can make money work without banks, make organizations work without corporations and courts, make sharing and transacting online work without big tech. And that because of all that, there's a better chance that tomorrow's misfits will be able to speak, share, and innovate. This uniquely American ideal, however, isn't about anarchy. It's about opportunity under the law. Bitcoin and follow-on cryptocurrencies are not unregulated. Sensible, technology-neutral regulations have protected consumers and investors and prevented money laundering and illicit finance. The American approach is to flexibly regulate activities, not to ban or blacklist the publishing of new ideas and tools. Anyone can freely write and share the open source software that makes these technologies work. Any prior restraint on sharing that expressive content violates our First Amendment rights. But if you promise an investor you'll invent and build them a new future cryptocurrency, we expect you to register as the issuer of a security. No one is made to open their homes and private Bitcoin wallets to a search by the police without a warrant, but if you provide a service to help people buy and sell Bitcoin as a third party, you are expected to know your customers and apply anti-money laundering controls. There are some gaps in America's crypto public policy. The gaps are not, contrary to popular belief, a central bank digital currency gap with China. The CCP is more interested in banning permissionless tools like Bitcoin and substituting a surveillance tool that will give them even more control over their misfits within their borders. We should not emulate that policy. The gaps are much more mundane. On the margin, securities and commodities futures laws can be improved, and there are well-drafted bills in the House that address those issues. Other gaps concern taxes. The recently passed infrastructure bill included rushed language that could unintentionally stifle innovation and invade personal privacy. There was a bipartisan solution with widespread support, but procedurally it was impossible to implement before the bill's passage. Existing IRS policy leaves taxpayers uncertain of their obligations with regard to cryptocurrency transactions. Tax issues are complex, so I've left specifics to my written testimony. Suffice it to say, there's no reason why America can't continue to be a home for permissionless innovation while also enriching its treasury. We did it with the early internet, and we will do it again with cryptocurrency networks. Thank you.
Thank you, Mr. Van Valkenburgh. Thank you all very much. Fascinating testimonies. I encourage all of us to read the longer versions too, because there's so much more content in them. Let me begin my 5 minutes of questions. Mr. Massad, you talked some about stable coins, and we just heard Mr. Van Valkenburgh say that, already we're sufficiently protected against too much illicit use of stable coins or cryptocurrencies, tax evasion, terrorism. And we read a number of times last week about Tether having the 64 billion, 70 billion, but not enough actual assets if converted. How do we protect investors from a run on a stable coin like Tether?
Thank you, Mr. Chairman, for the question. We have to have policies that require that the reserves that they receive, in other words, the money they receive for the tokens, are invested in highly safe liquid assets, ideally just cash, so that it's always there. What we have today is a situation where there are no requirements. And a firm like Tether has investments in commercial paper. We don't even know what kind of commercial paper. There's a lot of speculation that it's commercial paper in China. They have loans. They were found to have loans to affiliates. They may even have investments in cryptocurrencies. So that risk is that if there's a sudden spike in demand for redemptions, they will not be able to meet it, or if they have to liquidate assets, that could cause downward pressure on asset prices. If they in fact have $30 billion of commercial paper, that's a huge amount that would affect the market. So that's the main thing. And then we also have to address the ancillary arrangements, the fact that these things are traded on decentralized blockchains.
Right. We often wonder how many of these investors realize that these are not insured deposits, with FDIC
Well,
or whoever
that's a good
else.
question. There is a lot of stickiness, though, to people's use of Tether, because Tether plays a very important role. It allows people to move value around between exchanges and between cryptocurrencies. And frankly, Tether illustrates that our payment system needs to be modernized, needs to be improved. That's why it's grown so much. It's also probably grown because it is a vehicle for tax evasion and potentially for illicit activity.
Thank you. Ms. Goldstein, in your written testimony, you highlighted the squid incident, where developers pulled all the liquidity out of the coin. Can you explain how a rug pull works and what we can do to prevent rug pulls?
So a rug pull typically happens when a developer creates a token, puts it on a blockchain, whether it be the Ethereum blockchain or another blockchain. There's lots to choose from: Avalanche, Harmony One, take your pick, Binance Smart Chain. And you create what's called a liquidity pool for it. And what that involves is going to a decentralized exchange like Uniswap or one of their competitors and basically putting two tokens together: your new token, your Squid Game token, and usually a stable coin. And you put enough volume of those two tokens on there so that people who want to buy your Squid token can go in, use the stable coin that they have put into the liquidity pool, and buy their Squid Game token. But because they are the ones who have sort of initially provided the liquidity for that pool, once people come in and they buy the Squid Game token, they can also pull that liquidity out at any time and essentially cause the price of the token to crash. So they basically tend to wait until enough people buy it up that the price begins to run up, and it runs up sufficiently enough that this new token that they've minted out of thin air, right, they've created it out of nothing, is worth something. Then they pull all the liquidity out and run off with the money, and that's what happened with the Squid Game token.
Thank you very much. I think Professor Werbach, Senator Lee talked about a light touch and not centralizing everything in Washington, D.C. With the fear that too much regulation stifles innovation. How do you see that trade-off, or even that supportive network between regulation on the one hand and innovation on the other?
Regulation's not just one thing. There are many different kinds of regulation, and I think the concern is a valid one. There are ill-fitting regulations. There are situations where regulation is not necessary, but it's not inherently the case that having a regulated market is inconsistent with having an innovative market. If that were the case, then the U.S. would be the least regulated financial market in the world instead of one of the most regulated. Regulation can promote trust. There's a reason why our capital markets are so successful. People come here because they trust that it's a fair and open market and one that will allow their sophisticated activities in an appropriate way. So the question is really what kinds of regulations we have. And I agree with Mr. Van Valkenburgh. It's not that there is no regulation in this digital asset space. We have existing rules which in some cases are not being enforced. In some cases, there are questions about how they can be enforced for new kinds of assets. In some cases, there are gaps. So what we need to do is something like what we did 25 years ago with the internet: do an inventory, identify what the issues are, identify what the existing regulatory structures are, and identify where there are gaps, where there are problems, where the danger is that either the absence of regulation or the lack of clarity about regulation that exists will lead to these kinds of abuses and will lead to a situation where the market potentially collapses.
Thank you very much. Let me now yield to Senator Lee from Utah for 5 minutes.
Thanks so much, Mr. Chairman. Mr. Van Valkenburgh, I'd like to start with you, if that's all right. Sometimes when Congress discusses cryptocurrency, you see concerned faces. You see sometimes people reflecting a certain degree of fear or anxiety. But the conversation is almost always alarmist in nature when it comes up in these hallways and those on the other side of the Capitol. We hear claims to the effect that this is a space that's sort of analogous to the Wild Wild West and could likely lead to chaos, pandemonium, more criminal activity, and financial ruin on a widespread basis, including victimization by those who are least able to absorb risk. But as you've pointed out, the industry is in fact already regulated. I mean, crypto markets do in fact face consumer protections when enforced by a whole host of alphabet soup federal regulatory agencies: CFPB, FTC, CFTC, SEC, and FinCEN, just to name a few. State attorneys general also have authority. Is that accurate?
It's quite accurate, Senator.
And cryptocurrency and the blockchain technology that it's built on itself contains its own sort of mechanism for self-regulation and protections against fraud and abuse, does it not?
That's the foundational principle behind Bitcoin is that double spending, which is the most obvious type of fraud, counterfeiting of digital money, is policed for by a public, transparent ledger that anyone can audit and check themselves.
In fact, for these very reasons, aren't there ways in which crypto markets are always improving consumer safety and reducing financial risk?
Always improving is a strong statement. I think by virtue of these networks being inherently public, we have great advantages. However, by virtue of these technologies being very new, there is a steep learning curve. I'm very optimistic for the long-term future of the technology, however.
Because they're based on a new technology, they could offer some real advantages, it seems to me, to lower income customers who are looking either at them from the standpoint of something to invest in or something to use as a means of transferring money from one place to another. In some ways, there could be economic benefits to poor and middle-class consumers everywhere from them, couldn't there?
I think its greatest benefits, quite frankly, are not even here in the US. They're in countries that have literally no access to financial services because they don't have the rule of law. And the technology, even in its current state, can easily fill a gap in those places that have been left behind.
Like the underbanked. The underbanked could benefit significantly from it. So if we ban some of these privacy features in cryptocurrencies, or if we regulate them to death, how might we be precluding or missing out on some of the beneficial innovations that require privacy protections?
I think innovation and creativity require some sphere of privacy so that you're not immediately judged for the things that you're going to do that are non-traditional. And that was a big story of the internet. It was a bunch of misfits who felt like they could come up with a new idea for a social network or something like that and be able to experiment freely. I think the same will be true of open blockchain networks, which also afford people that free and open platform for experimentation.
Are you familiar with the phrase born in regulatory captivity versus born in regulatory freedom?
Yes.
It seems like it might be apropos here. Now, for Americans who own a little Bitcoin and use it to buy something or to send some money back home, how could Congress help make it easier for them to comply with the Byzantine labyrinth of legal implications that could accompany that?
I think the thing that Congress can do to help those folks most would be to regularize and make clear our tax policies, especially by providing a de minimis exemption from capital gains taxation for small cryptocurrency transactions, which otherwise trigger a capital gain and a need to report, and simply make using the technology very difficult. We have that kind of exemption for foreign currency transactions. It makes sense to have the same for cryptocurrency transactions.
Where would you be inclined to set the limit if you were king for a day and you had the ability to set the de minimis safe harbor? Where would you put it? Being
a humble person, I would set it where the foreign currency exemption is, and that is where it is set in legislation we've seen in the House from Del Bene and Mr. Schweikert.
Now, as you've noted, a lot of the barriers to innovation for cryptocurrencies come from existing laws and uncertainty about how those laws might be enforced. Some variation in whether it's an enforcers or an interpretation of existing authorities. In many cases, that uncertainty and overly broad interpretations of these existing financial regulations have begun to push some of this technology overseas, or at least some of the pioneering U.S. technology companies overseas. What do you think is the best way to protect consumers and to ensure that America remains, at the cutting edge of this type of innovation?
I would agree with my fellow panelists that stablecoins are an interesting area and that the regulatory field there is somewhat convoluted. There are certainly stablecoin issuers who are violating the law, who have not registered as state money transmitters or who have not chartered themselves as state banks or trust charters. There are also regulated stablecoin issuers. And there is also the possibility of creating more of a federal home for regulation of stablecoins. We don't have a legal gap there, I think. We just have an enforcement gap, and that is a real problem.
My time's expired. I appreciate your testimony. This really could be a boon for America's poor and middle class. Let's not get in the way of it.
Thank you, Senator, very much. Now recognize the senator from New Hampshire, Senator Hess.
Well, thank you very much, Mr. Chair and Ranking Member Lee, and thanks to all the witnesses today for your work. Ms. Goldstein, I want to start with a question to you. I recently wrote to several agencies, including the Department of Justice and the Treasury, highlighting a cyber attack on the town of Peterborough, New Hampshire. The perpetrators quickly converted most of the $2.3 million, which in a small town in New Hampshire, I can assure you, is a lot of money, in taxpayer dollars that they stole, and they converted it into cryptocurrency, making it unrecoverable. What actions can agencies take to prevent this kind of criminal activity, such as the rapid conversion of illicit funds into cryptocurrency?
Senator, thank you for your question. There are 4 suggestions that I have. The first is that a large portion of this marketplace likely falls under existing securities laws, and applying those rules, including rules that apply to broker-dealers, I think would help stop illicit actors' ability to move money anonymously and help prevent that sort of ransomware conversion. My second suggestion is the Treasury Department can enforce some guidance that they just put out in October. OFAC put out this clarification that if you do digital assets, you need to comply with sanctions. You need to check whoever is using your platform against the sanctions list. And I think the Treasury Department enforcing that guidance would be a good step forward. The third is anything the agencies can do with your help if needed to promote more information sharing can always help. FinCEN analysts can put out reports as a result of that. And the last thing I would suggest is that FinCEN has a very specific set of financial regulations regarding to financial crimes specifically. And I know you're already talking to them about this, but I think strong enforcement of those would also be helpful.
Okay, thank you so much. Mr. Massad, in the letters that I wrote, I emphasized how stronger know your customer requirements for cryptocurrency exchanges can curtail the criminal use of cryptocurrency. It becomes much harder to evade law enforcement when your name is attached to the cryptocurrency wallet you're using to commit crimes like ransomware attacks, drug trafficking, and money laundering. How could stronger know your customer requirements for cryptocurrency exchanges help authorities prevent and prosecute criminal uses of cryptocurrency?
Thank you for the question, Senator. It's extremely important, and one big example of this is what's happening with ransomware. There was a recent FinCEN report just issued a couple of weeks ago that documented how ransomware is increasing rapidly. I think the Colonial Pipeline incident was a real wake-up call, too, because that's a company that didn't have a lot of personal identifying information. It was an infrastructure company, and yet it was hit. I think we're going to see more of that. The FinCEN report talks about how these illicit actors often act through the crypto exchanges. They reuse addresses. They make multiple transfers of the illicit profits so they can't be traced. And, you know, KYC is critical here, and we need to bolster, you know, FinCEN in this. But it's more than that. We also have to have a structure of regulation around these exchanges. Coinbase, Kraken, these other exchanges, they're not subject to the same standards that we have for securities and derivatives exchanges. They're registered as money transmitters. That's a pretty light touch of regulation. They don't have standards to prevent fraud, to prevent conflicts of interest, to prevent things like wash trading. Wash trading is where you essentially trade with yourself or with an affiliate. Right. That's very, very common. And there's a very interesting CFTC action here. The CFTC only regulates derivatives contracts. So to say that, you know, the SEC or the CFTC has power over these exchanges is wrong, because the CFTC can't regulate that cash market for Bitcoin any more than it can regulate the sale of cows just because it regulates cattle futures.
Okay.
And yet it does have very limited power to bring fraud actions, but that takes a lot of resources to do. They did bring one against Coinbase, but even one of the Republican commissioners said, you know, this is going to mislead the public into thinking that we regulate these exchanges, and we don't. So it's a broader problem than just KYC standards, but that's critical.
Okay, that's very helpful. Thank you. One more question, again for you, Ms. Goldstein. I recently introduced a bipartisan bill with Senator Ernst that would require Treasury to report to Congress on how cryptocurrency is used globally and its effects on global supply chains. How has cryptocurrency mining affected global supply chains in recent years, including for critical technologies such as semiconductors?
Well, Senator, I commend you and your fellow senator for the bill and the report that you request. Essentially, crypto mining has an arms race. Their technology needs to improve all the time so they can keep up and make money, and that means often they have to replace the equipment very fast, and that means more demand for semiconductors. And that means less, electronics makers who need semiconductors for other things are able to access them. So I do think that there's a lot of research in particular showing, for example, graphics card need secondhand goes in conjunction with the price of ether, for example.
Okay, thank you very much, and thank you, Mr. Chair.
Yeah, thank you, Senator, very much. I recognize the gentleman from Arizona, Mr. Schweigert.
Thank you, Mr. Chairman. I may take this slightly a different way, just because, and you and I have worked on discussions around this for a long time. I have a fascination with distributed ledger. I think I hold the record of being the first one to actually mention Bitcoin in a Ron Paul hearing, believe it or not, many years ago. Could we spend a couple seconds, because three of you have sort of touched on it. Let's do some societal good. Transaction costs, using of my credit card, the wire transfer. What do we, as policymakers, need to do to, in many ways, use the technology that should crash the price of someone walking into, whether it be Walmart and using a credit card or sending money back to the family in Guatemala? This technology should be crashing that price. First, what do we as regulators need to do on that? And then we're going to go down the rabbit hole on a couple other things of identity and other things that could actually help. We were trying to do an experiment in Arizona of using a blockchain to identify homeless and the benefits attached to them and have it in a universal spot. So,
Thank you, Congressman. It's an excellent question. Stablecoins are one possible way to do that if they're properly regulated. A stablecoin is simply a token.
no, well, I'm sorry. I'm going to geek out with you. Just,
Yeah.
I'm very familiar with the underlying mechanism. As a matter of fact, years ago, I worked on an escrowing for a blockchain code to show you how far down the rabbit hole I went. But you think a stable coin would be your methodology for creating
faster
the
payment.
rails?
It certainly could be, because again, it's a token that's then backed by the dollar. And there's a
Could
lot
you
of
just use a
proposals.
stable token?
A stable token,
Where there's
an
acceptance.
algorithmic kind of.
Yeah, well, here's my piece of plastic. I swipe it over here. We have an agreement that it represents this many units.
Well, that's the hardware,
Yeah.
the plastic part. What I'm talking about is, currently, as you point out, our payment system it's essentially bank deposit dominated. Credit cards still go through banks, wire transfers go through banks, and banks, frankly, haven't innovated enough. With a stable coin, if properly regulated, you could potentially have new entrants into payments that then are creating new payment rails using that digital technology.
Okay, so instead of you and I going over the underlying technology, because we whiteboarded a fixed stable token, actually, which is pretty much the same thing. What do we have to do policy-wise to make that available? Because overnight, that would actually change cost in our society of using
Right.
3%, 5%.
Yes, it could. I think we need to create a regulatory framework to regulate those issuers so that, and the PWG report, I think, lays out a lot of the issues. My only concern with it is it recommends that Congress adopt legislation that says only insured depository institutions can
Yeah,
do
but
this.
that you
And-
just screwed up the cost structure again.
I think that limits competition.
Okay,
Right.
Mr. Valkenburgh. Same sort of question. How do I use distributed ledger, blockchain technology, whatever title you want to give it? I know this is more in crypto, but also using the knowledge that we're developing here to benefit society in those transactions.
So I think my fellow witness, Mr. Werbach, with his insights about the Clinton administration's framework for a global electronic commerce is on the money. Technologies back then, in the 1996 hearings about the internet, could not have allowed people to share high-speed video, could not have allowed people to have Zoom conferences instead of hearings, could not have allowed people to do online banking. You could send a very small amount of data through the internet at that point. We
I
didn't
was
have,
involved in the old Check 21.
Yes.
So give you an idea how far back.
yes. And in a very real sense today, we still are at that point with respect to cryptocurrencies. As my fellow witness said, sometimes the fees are actually quite high. And it seems as though there's no hope of moving more economic activity, let alone social networking transactions, identity transactions onto these networks. The layered architecture of these technologies, however, means that we have lots of avenues to build more scalable, more efficient solutions. And it's a story of free and open platforms that allow anyone to build that innovation. We gave a briefing in the House, I think in this very building, where we used the Lightning Network, an open payment network built on top of Bitcoin's open protocol, to buy candy from a candy machine. A transaction of half a penny got you M&Ms from the machine, and the fee for that transaction was 1/250th of a penny. That was actually a settled transaction that ultimately ended up batch settled without trust on the blockchain by the Lightning Network, far better than the correspondent banking system that we have today, ACH, credit card authorization.
I'm up against the time, but that's actually part of the discussion of ID, licensing, benefits, my ability to send some resources to grandma. I know the money is in the cryptocurrency, that's where the enthusiasm is, but sometimes I think we fail to understand, if we do this smartly, the benefits of distributed ledger and stable code, and code is ultimately insurable if we can ever get that far, could we actually also do some really good things to society, not only in our own country, but around the world? And with that, I yield back.
Thank you, David, very much. I recognize Senator from Southern California, Mr. Peters.
Wish I was a senator. That'd be a nice 6-year term, but I'm just a lowly representative. Thank you very much, Mr. Chairman. Thanks for having this hearing. This has actually been fascinating and a really good presentation. It sounds like we're struggling at the beginning of this phenomenon with using government to come up with fair rules like the markets have that people can trust without getting in the way of the innovation that can happen. I think that's a pretty common story, and we're just at the beginning of it. One issue I had for you, Ms. Goldstein, though, is to be fair, we want to make sure that this currency is not used for tax evasion. And I just want to refer to the bipartisan infrastructure framework. There was a provision that attempts to prevent tax evasion in the crypto space by requiring, starting in 2024, brokers to report cryptocurrency gains in a 1099-B form. I wonder what you thought of that as a measure to curb tax evasion. Is that sufficient, or do you think there are other particular measures that we should pursue?
I'm a supporter of that language. I think it's important. I think, we talk a lot about innovation in this space, but, there's a lot of companies we may not think of as so innovative, like Charles Schwab or TD Ameritrade, and they are supplying those sorts of tax reporting every day. And I think I had to do my cryptocurrency taxes last year. And because I did not get a 1099-B form from a lot of the different platforms that I used, I had to pay a third-party vendor over $100 or $200, I don't exactly remember, in order to generate my tax form for me so that I could submit it to the IRS and make sure that my crypto taxes were paid appropriately. Right. And so I think not only is there a benefit of sort of going after some of the tax evasion that, the administration has reported is happening, but there's also a benefit to the end user. It would make it a little bit easier for them to do their own taxes. The burden would no longer be on the own individual investor. It would be on the platform. Right,
and I assume in this industry we won't hear any back talk about how difficult it is to calculate this, because it's a pretty sophisticated operation, it seems like. I had a question for Mr. Massad. In a recent Brookings report, you suggest that the Financial Stability Oversight Council should commence a review of stablecoins. Can you tell us a little bit more about what you think in general, what we're going to get out of this, not at the level that Mr. Schweikert would understand, but maybe that the public could? Not to ding Mr. Schweikert, but it's no surprise he understands this at the same level as the witnesses.
The Financial Stability Oversight Council has the power under the Dodd-Frank Act to designate a payment activity as systemically important or likely to become systemically important. And I think, the growth of stablecoins from very low numbers to over 130 billion today, plus the potential future growth, if we did allow them to have broader application, might very well meet that test. If they do that, then the Federal Reserve is charged with developing risk management standards. So I think that is a way to create a regulatory framework. Certainly Congress could pass legislation too, but I think the FSOC could take that action, and that could address a lot of the issues that we've mentioned. Making sure the reserves are invested in cash, making sure there's liquidity, making sure there's operational resilience, and making sure things like KYC are adequately dealt with.
And that would certainly be an important thing in lieu of, there's no deposit guarantee. You'd certainly want to make sure
Correct.
there's cash behind this.
Correct. That's right. And today, some of the stablecoin issuers are registered as trust companies, but that state registration doesn't mandate all the standards that I'm talking about. It's still a light touch.
Mr. Werbach, tell me what the key differences are you'd identify between decentralized finance and traditional banking, and whether you think there's a potential that this in fact affects the integrity of the dollar, this whole phenomenon.
Well, decentralized finance is essentially transforming finance and financial services entirely into software. So it's about financial services that settle on a blockchain, a decentralized ledger, that are non-custodial. So you don't give up control of your assets to the third party, and that are open, programmable, and composable. So this is basically open source software, and these pieces can be plugged into each other. It's a much more open and dynamic way of doing financial services, and it's one reason that we've seen an explosion of activity in DeFi, and companies coming up with new kinds of opportunities, which can be very beneficial. The problem is they do it without the kinds of restraints that we have in the traditional system. And some of those restraints are very important for all the reasons that my fellow witnesses and I have talked about, whether it's about money laundering or about protecting investors. So the answer is not to go back to the banking system and to prevent DeFi from happening. The question is, first of all, understanding what those risks are. And also understanding what's happening in the marketplace. Because, for example, there are DeFi insurance platforms that are coming into existence that allow you to hedge against the risk that, for example, there's a hack on a DeFi service. But again, all of this is so new that we don't have an understanding of what it is.
Okay, I appreciate it. My time has expired, but again, thank you for the hearing, and thank you to the witnesses.
Thank you very much, Congressman. Next, recognize the Congressman from Kansas, Mr. Estes.
Thank you, Mr. Chairman, and thank you for all our witnesses for being here today. This is a great topic for us to be talking about. Obviously, when we look to the future, a lot of technology out there and where we can possibly go with the country. And I want to go back and, we talked a little bit about this, but, over the past 30 years, we've seen a number of innovations tied directly to the internet. And, a lot of rapid developments and adaptations. And really, it was impossible to know how the internet would function back when, it was first being formed. So, today we see that the blockchain technology and the capability there that gives Americans the ability to reliably record information without having an intermediary to act as the recorder of that information. I think there's a whole host of potential applications from across the economy, from land titles and ownership records to contracts and improving security, over and above what we frequently have talked about in terms of crypto technology as being used as a currency. And I think there's a lot of decisions we have to make in both areas. But just like when the internet was new, we need to be careful about how Congress approaches these new technologies and what regulations we put in place. Just like there were many false starts with internet during the dot-com bubble, but today it's really a critical tool that we have. It's a good thing that Congress didn't regulate the internet out of existence in the 1990s before it was clear what all those uses could be. And I hope that, as we work through this process, we can come up with a goal that makes sure that we don't impose unnecessary barriers to the innovation. I hope that, along with looking for protection from bad actors, Congress is very deliberative in its process and coming up with those legislative decisions that will help this technology grow and expand for things that we haven't even thought of today or discussed today. I do have a couple questions. Mr. Van Valkenburgh, what do you see as some of the exciting technologies that are exciting applications that we can use with the blockchain technology going forward?
Thank you, Congressman. And your colleague, Mr. Schweikert, was going down this avenue as well. I think I'd like to talk about identity. So when we think of blockchain networks, as you said just now, we often think mostly about money. And cryptocurrencies, or the scarce commodity-like tokens that power them, are essential to the operation of these systems because they create a fair reward for anyone who donates computing power to secure the blockchains and the data on that blockchain. So you don't need to permission who can secure that data. You have an open competition of people securing that data and doing it transparently and getting a fair reward on the blockchain. But that said, once the blockchain is secure, you can put information in that blockchain that goes beyond merely a transaction where I pay Mr. Schweikert a Bitcoin. You could put a transaction on that blockchain where I testified in front of Congressman Schweikert, and I attested to my identity by using a unique cryptographic key on my phone when they let me in the front door. This kind of identity transaction is another intermediated transaction when it takes place on the internet today. We rely on major corporations to run our social networks, to run our credit reporting agencies, to run all of the tools and systems that identify us, that permission our access to buildings. The OPM uses major enterprise identity providers in order to secure government buildings for personnel. All of these ledgers are centralized and siloed and can ultimately be improved and decentralized by using open blockchain networks to secure identity transactional data rather than trusting one corporation or company to do that. To that end, Microsoft has pioneered something called the ION network. It's not Microsoft's technology per se. They're developing an open standard and contributing, along with other corporations, to a decentralized identity standard that would actually anchor identity data into the Bitcoin blockchain. So it's more secure and less vulnerable as a centralized data repository would be to hacking and ransomware and such.
So basically, what you've taken was very complex, trying to figure out how to deal with cryptocurrency, and now made it even worse, or much more complex in terms of all the applications we can, yeah. So, I know I'm about out of time. I don't know if you can say a quick comment about cybersecurity and how that might affect and be positive through this.
Sure. So when we think of cryptocurrencies and cybersecurity, we often jump to ransomware because it is used as a payment for ransomware. I think it's important to point out that, as Deputy Treasury Secretary Wally Adeyemo said in a speech last week, quote, ransomware is not a cryptocurrency problem in the same way online fraud schemes are not the fault of the internet. In fact, I would go further and say that cryptocurrency technologies are ultimately the solution to ransomware cybersecurity issues, because the big tech paradigm of securing user data in a centralized database is what creates vulnerability to hacking. If we decentralize control over that data, decentralize a social network, decentralize an identity provider, you lose that single point of failure and that vulnerability from a ransomware and hacking perspective.
Well, you've certainly given us a lot to think about and try to figure out what we do. So, Mr. Chairman, I yield back.
Thank you, Mr. Estes, very much. And I recognize the distinguished Congresswoman from Columbus, Ohio. Ms. Beatty.
Thank you, Mr. Chairman, and thank you to our witnesses and my colleagues. This is very intriguing, and I want to come back to it, but I want to say this before my time runs out. I'm really interested in the capital gains issue and how that would work as we deal with it in crypto versus, I know how it works in real money when you have capital gains and how you have to apply to it. So I don't know if I have enough time, but I'm going to ask my question, but I want to come back to that. But I'll stay with you, Mr. Valkenburgh. I hope I got that right. I have a large Somali immigrant population in my district. Matter of fact, I have the second highest in the country to Minnesota. And I've worked with them and many business individuals and the Treasury for years to help them solve their remittances issue because Somalia does not have an adequate central banking system. Can you describe how Bitcoin and crypto can potentially help with remittances or not? Because right now they're traveling to Dubai once a month and sometimes with incredibly large millions of dollars in a briefcase to get it back to come to Somali.
So the value of Bitcoin and other permissionless open blockchain networks for remittances is that it makes starting a new remittances business, the barriers to entry in that field of endeavor, much lower. You don't need to gain access to an ACH network. You don't need to have a well-functioning financial system in, say, the destination nation for the payment. Now, that said, I want to be sober about this. You still may have last-mile concerns. If the person at the other end of the remittance is happy getting a decentralized cryptocurrency, then they may be able to receive that cryptocurrency using nothing more than a phone and an internet connection, which in many parts of the world may be something you'd be more likely to have than access to well-functioning financial services. However, if you want local currency, you'll need to find someone willing to exchange the decentralized cryptocurrency for the local currency, and that is another point for potential failures or a place where regulation may be necessary because that's a trusted activity.
Mr. Werbach, I know you have gone around the country giving lectures to business folks, attorneys, and in your book when you talk about this being the new architect. Any comments on that? Because I think you hit on something. You know, you have to have it on both ends. And how advanced do we know for this population that I just mentioned? Do you have any intel on what's happening in Somali with this?
Well, this is something that is developing in the marketplace. Early on, when Bitcoin came around and cryptocurrencies came into existence, people said, obviously, this is going to be the solution for remittances. It's so much cheaper, you don't have the intermediation. Many companies went into the market thinking they would deploy these solutions, and in most cases they failed, or in most cases they were outcompeted by traditional kinds of services, in part because of these last mile issues. And in part because, in many ways, the transaction in the middle of the network is fairly efficient under modern financial systems. So really what we need to see is how the market is developing and where there are solutions as the technology evolves on both ends. And for example, as we have systems like the Lightning Network that Mr. Van Valkenburgh talked about that may lead to more efficiency of these payments, then it's certainly possible that a cryptocurrency-based remittances system will be a better solution. But we shouldn't prejudge. We shouldn't be in favor of one technology over the other. We should encourage the so-called traditional financial technologies to evolve and develop as well, and have a marketplace that ultimately is best for the people using it.
Okay, thank you. Try to get one more question in. Mr. Massad, in your testimony, you spent a great deal of time addressing the slow and expensive payment system that we have in the United States. You even say that cryptocurrency, namely central bank digital currency, is one way to address this, but the Federal Reserve has been working on a faster payment system for a few years. And many other countries, with many other countries around the world, have a real-time payment system without the use of the central bank digital currency. Wouldn't the easiest route to address this outdated payment system be just to move into a real-time payment system, which the Feds is already working on, as opposed to creating a whole new system with central banking digital currency?
That's an excellent question, Congresswoman. The Fed initiative, which is called Fed Now, will certainly help a lot. The question, though, is, first, it's going to take a little while before it even comes online, but more importantly, will the benefits of Fed Now really be widely distributed? Banks have to decide if they can manage it, if their own systems are capable of using it, and will they pass on the benefits? My concern is we need more competition to ensure innovation. The other thing about Fed Now is that technology probably doesn't have the throughput that blockchain-type technologies have, so I don't think it would be as good, and it's not clear you can develop smart contracts and so forth. So, you know, it's one option, but I think we need to look at these others. And if I may, going back to your question on remittances, also incredibly important, it really should be as easy as sending an email to send money abroad. And, you know, I think, again, digital technologies digital assets properly regulated could do that. I would favor stablecoins or CBDCs, though, over something like Bitcoin.
Thank you, Congresswoman. And now, the gentleman from Texas, Mr. Arrington.
Bringing up the rear over here, Mr. Chairman. Thank y'all for your insights. It was a great discussion so far, and the panel has certainly helped educate me on something that I'm not so familiar with, so I admit that from the outset. And Mr. Valkenburgh, what a eloquent and powerful picture of America as the laboratory of innovation as a result of freedom. Free people, free markets, unleashing creativity, ingenuity, and creating value for customers, not just here, but around the world. So thank you for that. I loved listening to the uniquely American ideal that I think we all subscribe to, by the way. At least that's what I'm hearing from the other witnesses. And I heard Mr. Werbach talk about a light touch. Maybe you said something like minimalistic legal construct. We want to all balance innovation and the need for having rules and basic safeguards. And because I don't know as much as I need to give any informed comments beyond this. I was a former regulator as chief of staff at the FDIC for many years, and a lot of the regulations there were derived from the risk to the deposit insurance, right? I mean, with that came a lot of risk management on the safety and soundness, and then there were lots of consumer protection regulations and rules to follow. Absent systemic risk and a deposit insurance for consumers that the taxpayers are ultimately accountable for as a backstop, where are the gaps here? If there was one thing you could all agree on in terms of filling the gaps to make sure we had basic safeguards, but we were not in any way, I think you said that in some ways regulation and appropriately applied at the right time in the maturation process can support this, not stifle it. I agree with that. So what could you all agree on? One or two things that maybe kind of the 80-20 rule, a few things that could close the gap most significantly, where there would be common ground among my colleagues and I.
Thank you, Congressman. That's an excellent question. I think we would all actually agree on taxes. I did want to bring up a point earlier about the bipartisan infrastructure legislation and the self-reporting, third-party reporting, provisions that were in that piece of legislation. As I said, there is language that was vague and therefore could stifle innovation and harm personal privacy. And so I do think a fix to that language is important. And there was a bipartisan fix in the Senate. It just could not procedurally be implemented. But I'm not saying that because I'm against third-party reporting. In fact, folks in the cryptocurrency ecosystem have been asking for guidance from the IRS if they're running a company that helps someone buy Bitcoin. How can they do specifically third-party reporting for their customers to make sure that their customers can easily comply with taxes? Because I agree with Ms. Goldstein. When I've filed my crypto taxes, it is not easy. So clarity there is important. I just think we should be careful the way we draft these laws, and there were some slight issues with the language in the infrastructure bill. Again, I would say a de minimis exemption from capital gains taxation for small transactions is a sensible tax policy, and we could also have better tax policy with respect to assets that people receive because of cryptocurrency forks, which I'll not dare explain at the moment, but Representative Emmer in the House actually has proposed excellent legislation to address that issue.
Thank you, Mr. Werbach. Do you agree, and would you add, what would you add to that?
Well, I would agree with that. I think we all agree that stablecoins are an area where there needs to be some investigation. We may not all agree on precisely what that should entail or whether additional legislation is needed, but I think we would agree that there are actors in that marketplace who are non-compliant, who purport not to do business in the U.S., and yet are listed on virtually every U.S.-based exchange. So I think we would agree that's something where there's a need for action. I think we might agree on this issue that Mr. Massad talked about in terms of the gap on spot market exchange regulation. Again, not necessarily in exactly what that looks like, but if there is a third-party exchange, then there needs to be some oversight for market integrity, just as we have with other kinds of exchanges. And the fact that the split between the CFTC and the SEC is what it is just creates an unfortunate byproduct in this area.
Thank you. Mr. Massad and
Yes.
Ms. Goldstein in the final seconds here.
First of all, I'm pleased that Mr. Werbach agrees on the spot market. And just to clarify, a lot of people think, well, it's either a security or a commodity. So that means the SEC and the CFTC just have to decide how to regulate this, which one is going to do it. That's not the case. The SEC can only regulate the digital assets that are securities. The CFTC regulates futures and swaps that are based on those other digital tokens, and even sometimes on digital tokens that are securities. But again, that means the CFTC can regulate Bitcoin futures the same way it regulates cattle futures, but the CFTC doesn't regulate the buying and selling of cows. Nobody regulates the buying and selling of Bitcoin. It just, other than the states, but that's a very light touch. The other thing I think we might be able to agree on is the importance of KYC, know your customer, and anti-money laundering. The system we have now is essentially trying to check that at what we call the on-ramps and the off-ramps. So as you go into the crypto market or come out of the crypto market and exchange that for dollars, that's good, and I think FinCEN has done a pretty good job there. But where we might start to differ is as the crypto market grows and you're able to do more and more things with crypto and you don't have to cash out, how do we prevent that illicit activity then? That's where it gets tougher. Where, what do we do about what's called unhosted wallets? What do we do about DeFi transactions? How do you have reasonable KYC that's risk-based, that doesn't try to, regulate every single transaction, that recognizes people are entitled to some privacy, but we still got to prevent that illicit behavior, and that's tricky.
Thank you, Mr. Massad. Mr. Chairman, it's
The
an
chair
excellent
might
hearing.
allow-
Would you indulge the final comment from the witness?
Absolutely.
Thank you.
Thank you, Chair.
He's never this nice to me, by the way, when you're not around.
I appreciate the flexibility, and I appreciate all the fellow witnesses' comments. I think Mr. Van Valkenburgh and I certainly agree that crypto taxes are very difficult. I think we may disagree about the solution. I would prefer the base infrastructure build text. I think two things we may all agree on. There are laws that apply currently to digital asset marketplaces, and those laws should be enforced. And the other thing that maybe we can agree on is that the market data could be a lot better. Right now, we really rely on the exchanges themselves to self-report, and I think some standardization of that market data is something we could potentially all agree on.
Excellent. Thank you. Thank you, Mr. Chairman.
And I want to announce our next hearing is going to be on cryptocurrency forks. Let me recognize the penultimate questioner. Apparently, Senator Cruz is on his way. And a vote has just been called in the House, not the Senate. So the distinguished gentleman from Madison, Wisconsin.
Thank you very much, Mr. Chairman, and being here, everyone has done a very good discussion education for someone like myself that doesn't follow cryptocurrency. I am so sorry. Okay, there we go. Sorry about that. This has been a great education, perhaps I'll say, for someone like myself that isn't super well versed in cryptocurrency. I spend much of my time thinking about the 40% of the people who don't have $400 in the bank for emergency expense. So I guess the questions I'm going to ask are more based on the calls we get into our office. I know in about an 8-month period, just recently, I think from October of 2020 to May of 2021, 7,000 people reported scams to the tune of about $80 million on cryptocurrency, or crypto scams, really. It's not necessarily on currency. Ms. Goldstein, I'm just kind of curious, what are some of the inherent risks to digital assets that aren't necessarily in traditional investments? And specifically, what are some of the areas as regulators should be investigating in this space to protect consumers, that average person who calls a congressional office who doesn't follow cryptocurrency anywhere near the level of discussion we had today?
Well, thank you for the question, Congressman. I think there's a lot of different risks in the digital assets marketplace that are particularly unique. One is that individual users are sort of, they need to manage the counterparty risk themselves in a way that you traditionally wouldn't in the banking system, right? You have a bank account and it's FDIC insurance. You're not worrying about who's on the other side. That's also true if you're trading stocks, right? You might rely on SIPC, and you pretty much can guarantee that if you trade a stock at the end of the day, you'll probably get it, right? And there are protections in place because we have markets and those markets have rules. You don't necessarily know that that's true when you're engaging in some of these cryptocurrency transactions. I think some of the other risks are risks of the kind of scams that you're probably getting calls about, right? We mentioned the squid coin, right? There's the ability to create these tokens that you can buy and then never sell. And if you're not able to read the code to identify that when you're purchasing the token, you may fall prey to that scam. There's also potential for market manipulation. There's a lot of really big, what they call whales, whether those are crypto hedge funds or exchanges that have prop trading arms that are owned by their CEOs, whatever it may be. There's real potential here for market manipulation. There's even a whole technical term for it, miner extractable value, which is the ability of cryptocurrency miners to sort of rearrange transactions in ways that they profit from. So all of this would benefit, obviously, from existing laws being enforced, but also perhaps to the extent that you and Congress see that there are gaps, making sure that the rules that we are used to in the sort of traditional markets are applied here so that individual investors aren't subject to these kinds of market manipulation.
And then if you just crank it up a couple notches, so rather than that individual be getting scammed, are we at any risk of having a broader, more systematic risk to our country? And what specific kind of regulatory effects do we need to do in order to safeguard against that?
Well, Congressman, I think it's a great question and it's a hard one to answer because the market is very opaque right now. And there are a lot of entities that are private funds, whether they're family offices or hedge funds, hedge funds do some basic reporting, but they're not required to report their cryptocurrency transactions on the Form 13F that the SEC makes them file every quarter. Family offices have no reporting requirements whatsoever. So it's a little hard to tell, but we have industry data, right? We know that institutional investors are more and more interested, private funds in particular, in getting in this space. And what I worry about is contagion. So I think about Archegos, right? That was one family office that was able to cause billions of dollars in losses to banks who all happened to be on the same side of the same basket of trades. If too big to fail banks are also counterparties to hedge funds who also have big cryptocurrency portfolios, and there's volatility in that market that may lead them to sell non-crypto assets, and they're all selling their non-crypto assets at the same time, you could lead to a spiral which could perhaps impact the economy. So that's the way I'm thinking about contagion, given the limited data that we have to really understand the complete picture.
Well, I look forward to however this conversation, Mr. Chairman, continues. I know our colleague, former colleague, Jared Polis, was quite successful in this area, but he was quite successful to begin with. I think what I'm looking for is on that average, call that we get into the office, someone who didn't have a lot of money to begin with and tried something and got scammed, just to make sure we have the right regulatory network to protect that person. So I yield back. Thank you very much.
Thank you, Congressman Pocan. Now the distinguished senator and astronaut from Arizona, Senator Kelly.
Thank you, Mr. Chairman, and thank you, everybody, for being here today. I really appreciate it. Ms. Goldstein, question about stable coins. But first of all, new technology is something I'm always very interested in, and innovation. I think it's one of our things our country does so well. But I am concerned about cryptocurrency and stable coins. And one aspect of stable coins is that, in theory, it provides a bit more stability, linking the coin to a reserve. But a key issue to address as it relates to stable coins is ensuring sufficient transparency to protect the users, the folks who buy stable coins. So how do we ensure that there is sufficient transparency about the reserves utilized in stabilizing the coin's value? So could you talk a little bit about that, the transparency and the requirements for disclosure, if there are some?
Thank you for the question, Senator. I think there are a lot of different ways that we could approach this problem, and it sort of depends on the stablecoin, right? Some stablecoins are algorithmic, and they have a basket of assets, and they move around. Some are meant to be pegged to the dollar or another fiat currency. And I think there are a lot of different places that different regulators could approach this problem. Some stablecoins may be securities that should be regulated by the SEC, which would bring a substantial amount of transparency. The Presidential Working Group has considered, that the prudential regulators have asked Congress to look into doing some legislation around stablecoins. There's also a role for FinCEN to play and make sure that stablecoin issuers who are doing redemptions and also issuing these new stablecoins aren't doing anything that involves any sort of financial crimes. There's also, I think, an important piece about stablecoins, which is that DeFi doesn't work without stablecoins. And that is a new and emerging piece of this marketplace that is operating in some cases without adherence to some of our existing laws like Know Your Customer, anti-money laundering compliance, and combating terrorist financing. So I think, unfortunately, there's no easy answer. There's perhaps a role for every single regulator and, of course, a role for state attorneys general, right? I actually think that Tether might be a little bit behind. They're supposed to give a quarterly disclosure about their reserves, and I'm not quite sure that they have done that on time. So there's also a role for state law enforcement as well.
So in general, do you feel we need more transparency and disclosure than we have today with regards to stablecoins?
I think that that would be helpful, but I also think that the regulators have a number of tools to ensure that currently, and I would encourage them to use the tools they currently have to make that happen.
Well, thank you, Ms. Goldstein, and Mr. Chairman, I yield back the remainder of my time.
Senator, thank you very much. And our ultimate questioner, the distinguished senator from Texas, Senator Cruz.
Thank you, Mr. Chairman, and I appreciate the adjective as the ultimate questioner. I'll take that with a chuckle. I have to say, I think cryptocurrency and Bitcoin mining provide enormous opportunities. They're creating vast amounts of wealth. They're creating a hedge for people against inflation. Inflation is a growing concern across the country. They're creating entrepreneurs in all 50 states. I'm also particularly proud that my home state of Texas is becoming an oasis for the blockchain community, for Bitcoin miners, for innovators and entrepreneurs in the crypto world. Unfortunately, the one thing that is capable of screwing all of this up is the United States Congress. And I have deep concerns that Congress is already in the process of doing so. As most people watching this hearing know, in the recently passed so-called bipartisan infrastructure bill, there are provisions targeting and inflicting enormous harms on the crypto industry. As originally drafted, the infrastructure package contained a provision that expands the definition of broker to nearly all participants in the cryptocurrency structure, treating them as a financial institution, which means they have to report consumer information to the IRS, even if those participants don't have access to that information. Additionally, the infrastructure bill included language incorporating digital assets into Section 6050I of the Internal Revenue Code, which states that in a broad range of scenarios, any person who receives over $10,000 in digital assets must verify the sender's personal information, including Social Security number, and sign and submit a report to the government within 15 days. And failure to comply results in mandatory fines and can be a felony with up to 5 years in prison. We have seen how crypto poses a threat to totalitarian regimes. For that reason, the Chinese Communist government recently acted to ban Bitcoin mining. And the sad reality of Congress legislating in this matter, I can speak at least for the Senate. I doubt there are 5 members of the United States Senate that could tell you what the hell a Bitcoin is. And legislating is always a messy process, but when it comes to legislating in an area where most members of this body have very little familiarity with the details, it is highly perilous. So, Mr. Van Valkenburgh, your testimony has addressed many of these concerns, but can you share what the impact is of the provisions in the bill just signed into law? And in particular address, I have this week introduced standalone legislation that would simply repeal these crypto provisions. And should Congress legislate in this area? Almost certainly, but it should do so after an awful lot of hearings and an awful lot of learning what's going on, and it should do so with an eye to not destroying this industry rather than simply using a machete and letting the consequences fall on the American people.
Thank you, Senator. I strongly agree that the 6050I reporting requirement represents a rather grave threat to personal privacy. In fact, I believe it's in contravention of our Fourth Amendment rights to not have our personal papers searched without a warrant. The Fourth Amendment protects our private papers when we keep them in our homes and when we have them on our persons. The Bank Secrecy Act, which is our Know Your Customer rules and anti-money laundering rules, is constitutional because those reports are filed by third parties, by banks, where the customer voluntarily provides their private information to the third party, and the third party holds it for a legitimate business purpose. The US Supreme Court found that to be constitutional then if the government gets that information without a warrant, which is why the Bank Secrecy Act is constitutional to this day. It's also why the government can go to Google and get your Gmail email history without a warrant. That was a compromise and a reading of the Fourth Amendment that the Supreme Court came up with in 1970 in California Bankers Association versus Schultz and Miller. Now, in the 6050I reporting context, please tell me who the third party is to a two-party transaction where someone receives more than $10,000 worth of Bitcoin. There is no third party, so how can the third party doctrine make a warrant unnecessary for the collection of that very intimate information, the Social Security number?
And let me ask you, if this new legislative provision, particularly if it's enforced aggressively by the Biden Treasury Department and Biden IRS, if it succeeds in decimating the Bitcoin and crypto industry and driving it overseas, is that good or bad for America?
Well, I believe it would be bad. However, I am optimistic. The provision doesn't go into effect until 2024. There are very reasonable and I think strong constitutional arguments to invalidate it before that happens. And I also think a lot of folks in Treasury actually have the right idea about this stuff and would actually agree that some level of privacy protections are important. So I don't think we're on the cusp of apocalypse as of yet.
Well, I hope you're right, and I hope Congress also acts to avoid apocalypse without rolling the dice and seeing if that prediction is right or wrong.
Only appropriate that the ultimate questioner brings up the apocalypse. Anyway, thank all of you very much for gathering with us. It's been a fascinating conversation, and I promise you every one of our panelists up here, Democrat and Republican, really enjoyed learning a lot more about cryptocurrency. I personally would love to learn how to become a miner, Ms. Goldstein. So, although when I was in Glasgow last week, at least more than one were talking about the energy impacts of mining and what that's its contribution to climate change. So formally, let me thank you for this important conversation on a very complex topic. Digital assets and cryptocurrencies have grown to become a globally significant financial market. Understanding these new and complicated forms of financial assets, activities, and products is necessary for Congress to address both the risks and benefits of this growing technology, and hopefully to do it in a balanced way that doesn't stifle innovation, that doesn't chase it overseas, but it makes sure that we're doing all the kind of protections that we need. Thank you for each of you for your timely contributions. Thank you for written remarks that are 10 times longer than what you offer verbally, which were excellent ideas. And thank all of my colleagues who have all gone to vote for their part in this discussion. This record will remain open for 3 days. This hearing is now adjourned.